Myself, Bharat Pimple. Now we are discussion on management accounting. Management accounting subject is BCom TY 5th semester. Firstly, we are discussion management accounting. Meaning of management accounting. Management accounting is the process of preparing report about business operation that help managers make a short-term and long-term decision. It helps a business pursue its goal by the identifying, measuring, analysis, interpreting and communicating information to manager. Management accounting is also is known as managerial accounting and can be defined as a process of providing financial information and resources to the managers in decision making. Management accounting is only used by the internal terms of organization, and this is the only things which makes it different from financial accounting. In this process, financial information and reports such as invoice, financial balance statement is shared by finance administration with the management team of the company. Now we are discussion on objectives of management accounting. Objectives of management accounting is to use this statistical data to take the better and accurate decision for controlling the enterprise's business activity and development. Now we show the ratio analysis. Ratio analysis is an important tool that is used in intra-business and inter-business for comparison. Now we show the types of ratio analysis. We see here the ratio analysis is broadly classified into four types. First is liquidity ratio. Liquidity ratio are an important class of financial merits to use to determine the debtor's ability to pay off current debits obligation without raising external capital. Liquidity ratio measures a company's ability to pay debit obligations and its margin of safety through the calculation of merits including the current ratio and liquid ratio. Next is profitability ratio. Profitability ratio means it is used to evaluate the company's ability to generate income as compared to its expenditure and other costs associated with the generate of income during a particular period. This ratio represents the financial result of company and enterprises. Let's we understand the details about profitability ratio. First is importance of profitability ratio. Profitability ratio represent the final performance of the company in particular period, how profit earning company other than expenses. It is also represent how the profit table owner fund have been utilized in the company. Next, types of profitability ratio. First, return on equity, earning per shares, dividend per shares, price earning ratio, return on capital employed, return on asset, gross profit and net of profit. 8 types of ratio or profitability ratio. Return on equity means this ratio measure profitability of equity fund invested in the company. It is also measure how profitability owner fund have been utilized to generate company revenue. It is formula profit after tax divided by net worth. Next, earning per shares. This ratio measures profitability from the point of view of ordinary shareholder. Third is dividend per shares. The ratio measures the amount of dividend distributed by the company to its shareholder. Formula of dividend per shares, amount distribution to shareholder divided by number of outstanding. Fourth is price earning ratio. The ratio used by the investors to check the undervalued and overvalued share price of the company. Fifth is return on capital employed. The ratio computes present returns in the company on the fund invested in the business by the owner. Formula of return on capital employed is net operating profit divided by capital employed into 100. That is formula of return on capital employed. 6 is return on asset. The ratio measures the earning per rupee of asset invested in the company. The high ratio represent better the company is formula of return on asset net profit divided by total asset. Second last, gross profit ratio. Gross profit ratio measures the marginal profit of the company. This ratio is used to measure the segment revenue of the company. A high ratio represents the greater profit margin its goods of the company. Formula of gross profit divided by sales into 100. Last, net profit. Net profit ratio measures overall profitability of the company and considering to all indirect cost. A high ratio represent positive return of the company and better position of the company. Formula of net profit ratio, net profit upon sales into 100. Next is activity ratio. Activity ratio means the activity ratio types of financial merits that increase how effectively a company is leveraging the asset on its balance sheet to generate revenue and cash. Commonly refers to efficiency ratio. Activity ratio helps analysis how a company handling inventory management, which is key of operating fraud of overall financial health of the company. The activity ratio broadly describe any types of financial merits that helps investors and research analyze the how efficiency of company use its asset to generate revenue and cash. Activity ratio may be utilized to compare two different business within the same sector. Activity ratio can be subdivided into merchandise inventories turnover ratio. Understanding activity ratio. Activity ratio are most useful when employed to compare two competing business within the same industry to determine how a particular company stack up among its peers. But activity ratio may also be used to track companies' fiscal progress over multiple recording period. To detect the change over time, this number can be mapped to present forward looking picture of a company's prospect performance. Next, solvency ratio. Solvency ratio, it is key merit used to measure the enterprise's ability or business ability to meet its long-term debt obligations, and it used often by the prospective business lenders. Solvency ratio indicates whether the company's cash flow is sufficient to meet long-term liabilities, and thus is the measures of its financial health. It can the likelihood that a company will default on its debit obligation. The main solvency ratio are the debit to asset ratio, the interest coverage ratio, equity ratio, and debit to equity ratio. The solvency ratio examines a company's ability to meet a long-term debit obligation. The main solvency ratio include the debit to asset ratio, the interest coverage ratio, equity ratio, and debit equity ratio. Solvency ratio can indicate the likelihood that a company will default on the debit obligation. Understanding the solvency ratio. Solvency ratio is one of many merits used to determine whether a company can stay solvent in the long-term debit. Types of solvency ratio. Solvency ratio, debit to equity ratio, that is part of solvency ratio, debit to asset ratio, equity ratio, and debit to equity ratio. Next, first is liquidity ratio. The ratio helps to measuring ability of the company. That is two components of liquidity ratio. First is current ratio and second is liquid ratio, are also called acid test ratio and quick ratio. First is show current ratio and or discussion on current ratio. Current ratio is calculated by dividing current liability. Formula of current ratio, current asset divided by current liabilities. Current asset means those assets which are convertible within the cash period, into cash period within the 1 year or short term period. It is called current asset. Liquid current liabilities means those liabilities which are payable within the 1 period, that is called current liability. The ratio is helps to investors, creditors, and understand to liability of the business. The ratio of ideal ratio of current ratios is 2 is 1. Next, liquid ratio. Liquid ratio are also called quick ratio and acid test ratio. The liquid ratio is calculated by dividing liquid asset by liquid liabilities. Formula of liquid ratio is equal to liquid asset divided by liquid liability. Liquid ratio helps to us find the solvency of 6 months and reason why inventory is subtract that inventory usually take more than 6 months to convert into cash. Illustration of on liquidity ratio. First is current ratio. The current ratio is calculated dividing current asset by current liability, and second, liquid ratio is calculated by dividing liquid asset by liquid liability. That is two components of liquidity ratio. Problems of current ratio and liquid ratio for solve. Balance sheet as on 31st March 2020. First is liability side, second that other side, asset side. First, equity shares capital 1,50,000, 6% debenture, 6% preference shares 50,000, 7% debentures 30,000, reserve and surplus 40,000, profit and loss account 10,000, bank overdraft. This is red. Red means current liabilities. Bank overdrafts 20,000, it is current liability. Creditors 30,000, it is current liability. Bills payable 20,000, it is current liability. Asset, on the asset side, land and building 1,10,000, fixed asset. Plant and machinery is fixed asset 80,000, stock 50,000, it is current asset. Debtors 30,000, it is current asset. Bills receivable 20,000, it is current asset. Cash 40,000, it is current asset. Goodwill 20,000, it is not current asset but it is intangible asset. Total balance sheet 3,50,000. Now we are show current ratio. Current ratio is equal to current asset upon current liability. Current asset, stock, debtors, bills receivable and cash. Totally 50, 30, total 80 and 20, 1 lakh and 1 lakh plus 40, total 1,40,000. 1,40,000 total current asset and total current liability 20,000, 30,000 and 20,000, total 70,000 current liabilities. We use formula current asset divided by current liabilities. Current asset 1,40,000, current liabilities 70,000. Total we include in figure in formulas. Current ratio is equal to current asset 1,40,000 divided by 70,000, total 2 is 1. Current ratio is equal to 2 is 1. Next, liquid ratio. Formula of liquid ratio: liquid asset divided by liquid liabilities. Liquid asset is equal to current asset minus stock. Total current asset 1,40,000. Next, now current asset 140, liquid current liability 70. 140 divided by 70 is equal to 2 is 1. That is current ratio. Thank you.